What's up, YouTube? It's Joe Catchpolia. Caught me sitting on the couch trying to make some money investing in real estate online again. If you haven't been following along, I've been investing myself for the last 20 years in real estate. I've sold real estate primarily to investors over a large portion of that time. So I've been in the industry, but recently have been spending some time looking for ways to invest online in just smaller pieces. I think that there's some real opportunity for maybe some people that aren't quite ready to jump into real estate with the amount of money that's needed to buy a whole property. They might be able to get a little bit of exposure. And with that lens, I've been checking out a bunch of different sites. I've put some money on some that I've decided make some sense. I actually already took some money off of one that I think I didn't do enough due diligence on the front end. That was Landa. Um, Today, I want to share with you what I've decided with Ark 7. What they are at the moment. A pretty small platform. You can see if you look at everything they have listed, it's one, two. They have 8 properties there, and then I don't know, these are all the ones that are currently being sold on their platform for the first time. And then they are a platform that allows trading. So if you've bought a piece of one of these properties, you can go ahead and turn around and sell them on their platform as well. But you can see it's very few properties so far. So it is a smaller platform, certainly than Landa or Arrived, at least from my impression of them. Um, they are different from Lofty in that they're not tokens. This isn't crypto based whatsoever. They are more similar to Landa and Arrived Home in that respect, where they're actually buying the property, putting it in an LLC, cutting that up into securities, and selling the securities. And so you can get all the paperwork on the SEC website, relative to what they've filed. But that's not really my expertise. What I really want to look at is a couple things. One, just how do I feel about the platform in general? What could I find online with some due diligence? That's a step that I missed when I was looking at Landa for sure, and I'll show you a comparison in a minute. But then the other is just actually looking at their deals, looking at the economics of their deals, and figuring out, like, does this even make sense from a real estate perspective? Does it make sense? And so, first of all, I think I mentioned a few times I put money into Landa, and then I'm trying to get it back out at the moment. I think that their platform is having some problems. You can see. So I just if you go to the Better Business Bureau site, which I find this. You're always going to have complaints no matter what business you see, but how they address them and how many they have relative to their size, I think is important. And you can just see, they had a whole bunch. If I had a lot of them are about the issue that I'm having, the speed and of being able to get money on and off the platform, whether they get it off at all. I wish I had, figured that out before I had sent them some. I think there were some, they're having a lot of other issues, and so that's why I decided against that. But if you look at Ark 7 so far, last 3 years, just 2 complaints. Last 12 months, just 2 complaints. I think part of this is a function of them being a significantly smaller company, but they have been in business for 6 years, and so it's not. And they have quite a few shares sold, so it's not as if there's they're a business, and that's why. But so in any case, doing that, and then I looked around online quite a bit, didn't find a whole lot about them, and I think it's because they're pretty small at the moment. But I did hear about them from a member of a Discord that invests in another platform that I'm on. So um, that person had generally nice things to say about them. At least I felt somewhat good and wanted to add at their offerings in general. And this is the step where, I found this home. This is they're currently their featured property. They don't give you addresses in these descriptions, which I don't particularly like. But I used Google Lens and found the property, and here it is. I mean, it's the same home. It was recently sold at the same price. This is the one. But so I was able to do a little bit of research, and so let me go back to that. They bought this for 630,000. That adds up, right? One of the things I'm curious about is, are they just buying great deals, right? Like, 'cause if they are, it's going to change my opinion of, whether or not I like the platform. And okay, Zillow thinks it's worth just slightly more than what they paid for it. So, um, a couple months ago, maybe that's true. Maybe that's just, they're a little bit off on that. But so that was neither good nor bad. I mean, they're certainly not just finding some deep value for you. But I wasn't too worried about that. This one's currently rented, 3,200 a month. They showed a 4% distribution. I was like, okay, that seems, they're not putting any debt on this property, so it seems a little bit high relative. And so, we're going to do some math today. So if you're averse to the nerdy portion of real estate investing, you're not going to be happy with what we're doing. But so let me just show you a couple things. Give me a little spreadsheet out. How can I? So hopefully you can see this. If not, I am going to just walk through the whole thing. Their offering is 710,000, despite that they bought the property for 630. And so where's the rest of that money coming? They have these closing costs and offering costs, and I think that's probably all the work that goes into creating the security. If you're just buying a property and you're paying all cash, it's been a while since I've bought something or been involved in any transactions in California, but this level of closing costs it's not the real estate transaction that's creating the bulk of these expenses. And then they charge a one-time sourcing fee, another $21,000, 21,300. On top of the closing costs, and then improvements in cash reserves. I'm going to take them at their word for that this is, stuff that's necessary. But so, that makes up 10,000 of this. So that difference, right? The difference between with all the fees relative to your purchase price, it's another 12.7%. But I think to be fair, we'll subtract out the 1039. Wow. Right, because like I said, I mean, I take them at their word that they did some improvements and they have cash reserves. But still, right off the bat, you're paying 11% more, you're paying 11% in fees, closing costs, and whatnot. And some of those are going to be legitimate, but you're just never getting there because, in general, as the buyer, you're not paying a commission. The real estate commissions, even after the recent settlement in most markets, you're not footing that bill, and if you are, you're getting some kind of a discount. And so, how that turns into 11% in closing costs is just beyond me. And I get, so that's a big hurdle to overcome, right? And they're saying, okay, minimum holding period a year. Well, if you turned around and sold this a year from now, unless it's appreciated 11%, once you pay closing costs again and commissions, you're going to lose money. They're saying a 3 to 8 year hold is the strategy. I really doubt even, in 3 years, you're going to be anywhere close to even breaking even. And so, you're going to be pretty far along before you get some profit on the appreciation side. At least in my opinion, I mean, you never know. I mean, the future is uncertain, right? Like you could have just some crazy boom, and that's one of the things they're saying is like, oh, we're picking these great markets, and we know how to find ones that are going to appreciate really well. And maybe 10 years from now, when they have a great track record of doing that, I'd put a lot of faith in that and expect to do a little bit better than average with these properties. But so far, that just doesn't. There's not. Excuse me. There doesn't seem like there's any reason to believe that's going to be the case. Okay, and so then the next thing I wanted to look at, I noticed their rental income doesn't match up with their projected rent, right? And so they have 3,200 a month. It's just a little bit different. It turned out to be exactly 3% different. I think what they're doing is baking in a vacancy and collection loss into this one. I'm not sure. There might be like some discount in the lease, and I missed that. But in any case, I think it's a good thing to assume you're going to have a vacancy and collection loss. I think it's pretty. I think it's somewhat reckless to say that's only going to be 3%. I mean, if you think about vacancy in terms of weeks, for every week a property is empty each year, that's almost 2% in vacancy. And so, like, if it's just vacant and takes a couple weeks to release, it's really easy to get to 4 or 5. And if you have to do any sort of make ready as part of that process, I think that ends up being not a very safe assumption most of the time. But in any case, it's better than what I've seen on some sites. Some sites are just completely ignoring that and just taking whatever your rent is that month. Lofty is guilty of that. Even though I like that site, the way that they're showing their numbers is it's not taking into account a lot of these things. But in any case, something I just wanted to point out. The other thing, it's not consistent when we're looking at another property. Then they have their projected expenses, $1,000 repairs and maintenance. Um, Seems really low to me. I mean, it is a relatively new home, but one of the things I noticed is they use the same exact amount on another property that is nothing like this one, and so I think that they're just sticking a plug number in there. And this has nothing to do with what they really expect. And so, okay, what ends up happening is if you're not properly budgeting for this and you're, uh, you know, it just makes your numbers a little inaccurate in the long run. But in any case, you take their net operating income, and if you want to run a cap rate on that relative to the purchase price, which is normally what you do, well, this is a 3.46 cap. I would never buy a residential investment property at a 3.46 cap rate. I don't care how much I like the area and think it's going to improve. I mean, it's very difficult to make any money in the long run doing that. You might benefit from appreciation for a period of time and still make money, but that's just a really low yield. And then if you look at the NOI relative to your actual initial offering, and that's what I have this IO here, that's even lower. And in both situations, your distributions have been above what your cap rate is. And I think the only real explanation for that is, they're not calculated in the same way, meaning like, there's no vacancy and collection loss being pulled out. They haven't actually had these repairs and maintenance yet. That's what I think is happening. But I'm really not positive, and I couldn't. I tried poking around on the site, and I couldn't figure out exactly where the math for this came from. And then one of the things, as I was looking through and looked in the operating agreement, and I found it again on this. This is our SEC filing. Is they're charging a 15? So okay, let me back up. On this property, I skipped right over this, but they're charging property management, 2688. This is actually a decent price in my mind. I think it's about 7% of the total income, and so that I believe is going to a third party property manager, and it's probably what the market is there. I don't currently have any properties of my own in California, so I can't say exactly what it is, but it seems like that's in line just from some of the investors I've talked to that have moved from here and been shocked at our higher rates here in Texas. So I think that's reasonable, right? I mean, you have property management. If there's a third party property manager, they need to get paid. But then out of your net operating income, they're also charging an asset management fee of 15% of the free cash flow. And as far as I could understand when I'm reading through this, that the free cash flow is relatively similar to the calculation for your NOI. There may be, some nuance to that where they're, um, dealing with reserves and whatnot. But in any case, I think if you just want to approximate, or I just want to approximate that, I put, okay, I'm netting out 15% of that. So I'm losing, even more relative to my NOI. And when you do that as cap rates, all of a sudden now we're at 2.6 when we calculate it relative to that initial offering price. And that to me is just absurd. So this property for sure was a no for me. Now, that doesn't mean that it's wrong for everyone, right? Like you might look at this and compare it to your other investment options and think, you know what, someone else is handling this for me. I'm getting that real estate exposure. I believe their story about, being able to get better appreciation. They're giving you these Zillow home index values, which I think are, and even if they were accurate looking backwards, which I don't necessarily believe that they are, I think that there are some flaws in the way that they work. So, for example, the difference between average home price and average price per square foot. Now, this is price per square foot's going up, and I actually like that a little bit better. You'll see on one of the other ones that's not the case. Um, in any case, maybe you believe that, and so maybe you make a different decision. But for me, this was a definite no. I looked at one in Dallas, which I could not find this one by doing a Google Lens search of the pictures. Um, I think it's because they did a renovation on this one, and so whenever they bought it, it didn't look anything like it looks now. That's my only guess. It could just be that the listing pictures are enough different that just couldn't pull them up. I'm not sure. I wasn't able to find that. But this one I think was even a little bit more crazy. So let me see. Let's look at the numbers for this one. And we're only gonna this is the only one more, but I wanted to show you a couple so you knew it's not just that one is an outlier, right? And so this is one they bought it for 196,200, rent 1650. Bigger distribution. This makes sense because your rent to price ratio is significantly better than the rent to price ratio. And I'm saying, when you compare your monthly rent to your purchase price, this is a much better ratio than when you compare it on this property, right? I mean, uh, we're looking at somewhere around 0.5%, and this is, more than 0.75%. That ratio. And if you don't know, when people talk about the 1% rule, these are the two numbers that they're comparing. This is 1% of that. But when we go down further, we're going to look at some of those same numbers. You'll see this one is just so much different, right? Their initial offering is 260,000 more than the purchase price. And so, when we just look on the surface, that's another 32.5%. But I think it's fair to back out the improvements and the cash reserves because, I'm going to believe them and say, okay, uh, they actually improved the property, especially because I couldn't find any other pictures that matched those. It makes me think that maybe they did a renovation. Could certainly be wrong about but that's the conclusion I drew. So, but even once you back that out, you're still talking about 17% um, added on top of your purchase price, and so that seems pretty tough to overcome in any short term, hold. Now, one of the things where they maybe did do a renovation, it's possible they created some real value. If I could have found the address, maybe there's some analysis to be done and say, okay, well, we're spending 260, but it's actually really worth 260 or more even because of the value they created. Or maybe it's not more, but it's not so far worse the way that it looks. Um, this one, when I looked at their annual rent, it was exactly what their projected rent is. So they're not doing any sort of vacancy or collection allowance um, in their math, and so that's a little bit worrisome. And then again, they just did $1,000 repair and maintenance, which, if you look at this property, it was built in 1928. Oh no, log me out. For some reason, this site does just constantly log me out. It might be that I have multiple tabs open. I don't know. But so if you look at this one, it is relatively newly renovated. But if you look on the outside, it does not look like it's in stellar shape, right? I mean, it might be freshly painted and have a nice new interior, but there's plenty of reason to believe that there's other problems to be had here. Oh, come on. Let me. You're gonna let me get back there or no? Okay. Well, that's a little bit annoying. Here we go. Um, but so let's get back to our math because that's the fun part, right? Everybody loves math. Uh, let's see. So the other thing, so when we're doing the same thing, right? Just trusting their NOI, which I think there's some reason to not necessarily trust it. 7% cap rate, actually, it's not terrible based on the purchase price, but it's actually fairly decent, I think, if that were the cap rate that we had. But once you get to the initial offering price, then, you're already down to 5.3. For this quality of property in this market, I just feel like you're paying too much. And so, give you comparison, I'm in San Antonio, Texas. I can go buy a brand new home from a new home builder, spend $200,000 and probably still get that 1650 in rent, right, per month instead of paying 260. And if I can't get it for 200, I can definitely get it for 210. And even with those, you're buying the home and then you have to put some blinds in. You have to do a couple of things. Sometimes you have to, you rekey because the builders don't ever use the ones that comply with your requirements as a landlord. But whatever the case is, you could buy a brand new home here in San Antonio for much less than this 260 and get a very similar rent, that 1650. I think we're very often hitting that. Definitely with homes that today you're getting under 225, and that's from builders who are buying down your rate today, and so you can get some relatively decent leverage as well. So when I compare that to, yes, this home is renovated, it's a different market, right? It's not San Antonio, it's Dallas, but it's not. It's not just some beautiful property that I really expect to be paying up for. I mean, if you look at the neighbors, which you have no control over that. This is just not where what I'd expect to be paying some premium cap rate for. And then again, once you throw in the fees, right, of the 15% asset management fee, you're getting down to, even on the purchase price, it's under 6%. But when you're looking at your offer, comparing it to your offer, it's 4.5. But somehow, again, in this case, they're paying out a distribution higher than that cap rate. It always bothers me when math is not working right like that. Um, but I think that it's, again, just a possibility that they have some allowances in the that are affecting the NOI that they're paying out when those things don't happen. They didn't spend 1,000 on repair and maintenance, so they just sent out the distribution. I mean, that's the only thing I could come up with. I could certainly be wrong. But so, again, and this is sort of what it just looked like when every property that I looked at, it just wasn't very appealing. I gotta log into this again, huh? Um, all right. And so then I thought, well, this is not anything new. When I looked at a lot of the lofty properties, ones that came up initially, were selling at $50 a token. I thought they were grossly overpriced. And it turns out many of them were. And they have later, those tokens have gone down to 20 or $30 a token. And then they make a whole bunch of sense at that price point. And so that's the situation that I think is an opportunity, is that you can go in and buy them on the secondary market, right? Buy them after they've been initially sold, but when somebody else is selling them out. And so I said, okay, well, let's take a look at the properties that we have. As far as that goes, I looked at quite a few of these, um, and there just doesn't seem to be that same. Um, I didn't find any that were at great discounts, and I'm not really sure why. I think part of it is because they are just paying it out. They are paying something out regularly, and they're not really. They might be over promising a little bit on their distributions in the long run, because it doesn't seem like they have a vacancy collection loss or a real capex reserve, or putting the right amount for future repairs and maintenance. But it. I don't think that these numbers are grossly off, but I think that they could be off to a certain extent. And all projections are virtually always wrong, right? I mean, they're never going to be perfect, but I think that that's a case where, um, it seems like they're sort of building in, creating a situation where they're distributing a little more than maybe is prudent. But again, I'm not completely sure how they got to that point where they're distributing a little bit more than their cap rate. I mean, it seems really odd to me that it seems consistent, but it's not something I'm terribly worried about. But because of that, it seems like there's not any steep discounts to be had, as far as any that I looked at. So because of that, because I didn't like any of the stuff that they have up initially, and I don't see any real deep value to be had, like where I'm buying those $20 tokens on Lofty that were originally sold at 50. So I decided I'm not putting any money on this one initially. I might revisit it. I'm trying to find sites that I think that there's real potential on, and I think what really kills this one is that 15% asset management fee. I don't think they're doing an amazing job finding properties, but I don't think they're terrible. So far, I haven't found a lot of complaints about how they're managing them or anything, which I had found a lot of info about that on some of the other platforms. And so I think it's a good platform itself. I think they're doing a decent job, but it's just really hard to overcome all those initial fees and the ongoing asset management fee. I just can't really understand how you can have those two things, and have those be as bloated as they are and actually make money on these. Um, but I could be wrong. And also too, if you're somebody who is just looking to get some real estate exposure, you're happy with these, relatively small cash cash on cash returns, especially considering there's no leverage. So, I think your risk is lower. You do have the platform risk that's as far as having somebody else managing it for you. If Ark 7 ends up going the way of some other platforms and not doing as well in the future, you're kind of stuck. There's not a lot you can do. Um, that's one of the other issues with it. Um, but overall, I think that they're doing a generally good job. They're just overcharging for the service that they're providing relative to the returns that you can get. So for me, I think I wouldn't be recommending this to somebody. I'm not even going to put any money on it because it just seems like, um, if I just trust the math exactly as they present it, it's just not a great deal relative to other options right now. And so, for me, at the moment, I'm going to keep investing on Lofty. I think there's a lot more opportunities there. Definitely going to keep putting money on ground floor. Again, it doesn't mean you should be using those two platforms. Definitely do your own due diligence. I do have two links in the description below where you can get some free money on each of them if you do decide to go forward and use those platforms. I got mine on each of them. I got a free $50 to start on Lofty, and then ground floor is even more generous. I got the $50, and then they're giving me some bonus for each dollar or for each $1,000 I put in. I think they give you another 20 or something. In the initial time period that they have. But I thought that was a nice little bonus on a platform that I was already going to invest in because I liked. If you've used Ark 7 and you have a different opinion than me, I'd love to hear it. I think that there's definitely things I could miss. It could be possible that it's a better platform than I realize, or that I'm misunderstanding something. If that's the case, I always want to know about it. I'm certainly making a lot of mistakes as I'm going through this. I'm going to lose some money. I'm not putting enough on that it's going to hurt me one way or the other if I do, at least for right now. Over time, I think, especially ground floor, I'll put a significant amount in. I think because it, for me and for what my goals are, it matches up pretty well. I think I'll probably do more on Lofty too because it's fun and there's like these little opportunities to get edges that I think, that the trading and the decentralized nature of it, and there's a lot of reasons, I'm enjoying that, but I don't necessarily think it meets the needs of what I'm looking for platform wise to like be able to recommend to novices. Um, So yeah, I'm really open to hearing other platforms that people have used and like and are actually getting a good return on. But I'm going to leave it there until next time. I'm going to keep making mistakes so that you don't have to.